Welcome everyone to the Way of the Trader. I am Sensei Kevlar. Congratulations on making it to your first dojo lesson. If you have made it this far without trading, you have definitely put yourself ahead of everyone else. The reason that I say that is because during this time, Bitcoin, if you had Bitcoin, has dropped a bunch while other things has moved up a bunch. You could have lost a whole ton of money if you were not being careful about what you were doing. But if you're taking the time to learn about these strategies, then these strategies will make you profitable in these markets. So what we're going to do today is we're going to dive into the fundamentals of how to read a chart and how to build our first strategy for being profitable in any market situation. What I have in front of me is I have a website TradingView. You can use any charting solution that you choose. It doesn't have to be this website or a website. It can be anything you want. But what I use is I use TradingView, and the reason that I use TradingView is because it works for me. It's a very efficient flow, and I really like their product a lot in terms of being able to draw charts and share them around with people. And so what I encourage you to do is sign up for the free trial of TradingView, and you can use the free trial as long as you want. You don't ever have to pay. And if you do feel that it's a good product and a good solution, think about a subscription. But for the most part, I gotta tell you, a lot of people don't have to. A lot of people can get away with just using the free version completely free. So you see this, me being a pro user, that's because I'm a power user. That doesn't mean that you have to be a power user out the gate. Don't spend money to solve problems you don't have. So I'm going to go here on TradingView, and I'm just going to pull up the first chart that comes to mind, which is kind of obvious to me. That would be Bitcoin, BTC, US dollar. Now, the way that TradingView works is you type in the market that you're interested in looking at, and right here in the ticker, and you click on the exchange that you want to view it at. So here's BTC, US dollar tether on the Bittrex exchange. And what I'm going to do is it's just going to give me a really basic chart. What I'm going to do is I'm going to click on the interactive chart. I'm just going to get rid of all my drawings here. Forget you saw that. What I'm looking at here is I'm looking at the price chart for US dollar tether on a 4-hour time frame on, in this case it's the Poloniex. I sworn I typed Bittrex. What happened there? BTC USDT on Bittrex. There we go. I'm looking at the price of Bitcoin against the US dollar on the Bittrex exchange. Each one of these candles represents a price range for a time frame. The time frame that we're looking at right here is 4 hours. So each one of these candles represents a price range of 4 hours. This is 4 hours, this is 4 hours, this is 4 hours, this is 4 hours. You put, you put enough of these together. If you were to make this a 1 hour chart, then it would be 24 of these candles, and that would be a day's time frame. Okay? What we're showing with regards to the price, right over here is the price. And what the candles show you is where the price was in that time frame. A red candle means that the price went down in that time frame, whereas a green candle means the price went up in that time frame. In the case of a red candle, the red candle opened high, moved all the way down to this bottom wick right here. You see this wick extending past the body of the candle? The price started here at the top of the candle, moved all the way down to the extreme of the wick, and then came all the way back up and ended its time in this 1 hour time frame right here at the bottom of the red candle. With a green candle, the opposite is true. The green candle opens at the bottom of the candle. The price went all the way as high as the extreme of the wick right here on the top of the candle before the price came back down inside of that hour time frame and closed that hour time frame right here at 6,000. What is that? 6,085. Okay. You can see that some of these candles have longer wicks than others. You can see that in the case of this green candle right here, the price opened here. At one point, it came all the way as low as here, the extreme. At one point, it came all the way as high as here, the other extreme, before coming all the way back down here in this time frame and closing out this hour-long time frame right here. Open, low, high, close. Open, low, high, close. Again, we have a red candle, so the open is on the top. Here's the low, here's the high, and then with the red candle, the close is on the bottom. So the price started high and it came down. Price started low and came up. Now, what I want to call your attention to is that when these candles come up and come down, they tend to do so in regular cycles. And the reason that they tend to do so in regular cycles is that when traders buy a stock, they buy a commodity, when they buy an asset on a market, what they do is they produce volume. These lines down here across the bottom, let me get rid of this so I'm not showing you too much. These lines down here across the bottom, this represents the volume. This is how much trading actually occurred. This is the price action. This is the amount that occurred within that price action. You can see that right here, we had very low volume during this time. During a time of very low volume, we also had very small price action. During a time of high volume, we also had lots of price action. So what you can see is that when the market was coming down and down and down and down, the volume was spiking up and up and up because people were selling and selling and selling and selling and pushing the market down. Then what happened is somebody said, oh, 3,000, huh? Yeah, I like 3,000. I think I'll buy a bunch of them. And that pushed the market up. You can see all the volume right here. And when you buy something, and when you buy a lot of it, that causes the market to push upwards. When you sell a lot of something, that causes the market to push downwards. Okay. So what happens is that traders come in here and they're looking at these charts and they're going, okay, it looks like the market is heading down. What price do I think I want to buy at? I think I want to buy around 3,000. And so what they're doing is they're setting their orders. They're setting their orders in the market to go ahead and buy at 3,000. Because with a limit order, you can just go ahead and set your order, wait for it to get filled, come back and see if it got filled. Now, what happened here is previously when we were going along back here in August, in July, we were just going along and we came up and we reached a new high of 4,400 on the Bitcoin. And then later we came on back down. Here we were seeing, this high right here, previously of 3,000. This is our 3,000 high. This is a very psychological number. These big round numbers, people see these numbers, they get excited about big round numbers with lots of zeros on the end of them. 3,000 is a nice round number. And so people get excited psychologically and they start doing things like selling when it reaches 3,000 because maybe they bought in back here at 1,000. Back here in April, they bought in at 1,000. It reaches 3,000. They have 3x their money. It's time to sell and take their profits, and so they do. And then the market comes down. Okay, and then the market reaches a better price, and they see this 2,000 number, psychological number, 2,000, lots of zeros, and they start buying again, and the market goes up. This psychology is critical. Understanding that this is what the market is, the traders in the market are looking at, and these are what the people are doing their buying and signals are, is how they are making their decisions about where the market will pivot, where the market will turn around. When you pivot on something, what that means is that, what we're trying to do is we're trying to turn the market around. We're trying to say, oh, I'm not going to go up any further, I'm going to go down. Or, up, I'm not going to go down any further, I'm going to go up. This is a pivot point. Okay? Now, when you're coming through and you're looking at these charts, what you'll find is on these historical pivot points, you'll find that these historical pivot points are respected very, very frequently. When the market is going up and people are buying and buying and buying, and they meet a point where the market needs to pivot and turn around, we call this resistance. You can see that there was resistance at this price point right here. Resistance in terms of, oh, it's gone up and I think I've done enough buying, let me do some selling, and that pushes the market down. So when the market is going up and we push against the top and then we pivot and turn around, that's called resistance. When the market is going down and we push against a pivot and we turn around and we go back up, that's called support. So right here, what I'm going to do is I'm going to come over here, and this is just my, my grabby tool. On the left-hand side of TradingView, I'm going to grab the line tool. I'm going to click on it twice, and I'm going to select the horizontal line tool. By clicking the horizontal line tool and then clicking my mouse at the top of that resistance point, what I'm going to do is I'm going to draw a horizontal line at that resistance point. This is just a point where the market came up, hit the resistance, pivoted, and came back down. Turned around. Pivoted on the resistance point. Okay. Same thing when the market was coming down, except I'm going to call that my support point. Okay. Now here, what we can see is that previously the market was going up and we ran into resistance. Then the market came down and we hit support. Here the market was going up and it looks like we might have run into more resistance, but look at what happened instead of hitting resistance. Instead, we were able to break through what was previously resistance at this point. And then when we started to come down, look at what happened. Look at where the market pivoted and turned around. Right there, at the 3,000 mark. So what previously, I'm sorry, at the 2,500 mark. So what previously had been 2,500 had been resistance when we were going up. When we were coming back down, 2,500 became support. And then we bounced off of that, and then we came back up again. And then we did it again. We came back down and we found support at this line and we came back up before coming back down and breaking through the support line. You see us break through the support line? This support was a little weak. We might say that it wasn't a very good support line. It looks more like a resistance line over here, where we're trying to go up, and now it's resistance again. Here, it was support because we were coming down, and then we moved, and we pivoted and went up. Here, it's resistance because we were going up, and we pivoted and came down. Now, let's keep following this trend and see what happens. Look at that. Isn't that interesting? As the market goes up and breaks through the resistance line, it becomes support again. And then as the market breaks down and goes through the support line, it becomes resistance again. Here, it's support. Here, it's resistance. It keeps on pivoting around this line. Every time it goes up and touches it, it tends to go down. Every time it goes up and breaks through it and then comes down again, it tends to go up again. This is a pivot line. This is a line at which the market pivots around. You can see it sit here and pivot around this market, this line right here. Here it's, here it's resistance, here it's support. Here it's support, here it's resistance. Over and over and over again, the 2,500 line in the Bitcoin market has been a very significant pivot point. Then what happened is finally we found support, 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 and then moon. Okay, let's do it again. Let's take this motion upward. Here we've got some nice motion upward where the market pivoted and then turned around again. Here we've got some nice market motion where the market pivoted and turned around again. Let's draw those lines. Here, this is resistance. Here, this is support. Here, this was resistance again. Thought we might come back down. No, we're going through resistance. Look at what happened when we were coming back down again on the previous resistance line. Previously, resistance now turned into support. Previously, where the market had pivoted and turned around and come down again, now the market is coming down and pivots on that line, except it goes up again. Okay. Here, we finally made it through to break through support, come on down. Look at where we paused for a minute. Right there on the previous support line. Okay. We broke through. That price got rejected, came back up, and this became what was previously resistance right here. Previously support right here became resistance right here. Now we're coming down. Up and down. Now we're pivoting around this line again. Okay? And then look at what happened. Is we were trying to go up again, and we found resistance. Where did we find resistance? At the previous support level. Let's do it again. Here's a line. This was resistance. Here it is, resistance. Let's do it again. This line's support. This line's resistance. This line's support. Came down and pivoted. Did it come up and touch resistance again and turn around? Yeah. Did it touch support again and turn around? Sure did. Do it again. Here's resistance. Here's support. Look at what happened. Let's just keep drawing all the lines that we can find in the market. All of our resistance and support lines. All of our pivot lines. All the places where the market turned around. Anyone noticing a pattern here? There is very clearly a pattern. These are evenly spaced. These are regular. These are highly predictable. If you were paying any attention to these markets and you saw that previously in the market had pivoted on this line right here, it'd be a pretty good guess that when we're coming down, the market is going to pivot on that line again. So how can we take advantage of this? Well, one way is we can think about in terms of, waiting for the market to come down and touch a support line. If the market is going to go up and then come down and touch the support line and then come up again, well, we could buy some right here and then sell it when it made it to the next resistance line. We could buy support, sell resistance. What kind of opportunity could we create for ourselves? Well, that's a 6% opportunity in an 8-hour time frame. 6% over the course of 8 hours. Normally, you can't get 1% a year from your bank. And I just showed you 6% over the course of 8 hours. Now, obviously, it's not that simple. I mean, if we always knew that the market was going to turn around on this line, we wouldn't do anything except buy this line. Obviously. If I really did know that this is the line it was going to turn around on and not this line or this line or this line or this line, well, I'd be a genius and I'd be a millionaire and I wouldn't have to teach you any of this stuff. I'd just tell you, well, you just have to buy on this line. That's all you have to do. Of course, I don't know that. If I knew that, I'd just tell you to buy on this line. I didn't know it was going to be this line. You can see this thing actually came flying down and touched this line before it came flying back up. Let's see if we can see that clearer on a 1-hour chart. Yeah, it's a little bit easier to see. Look at it come all the way down, touch this support line, and go flying back up. Well, if you had had a market order in at 5,431, you would have gotten your order hit as this guy sold into this. You could have bought at 5,431. You could have been selling 1, 2, 3, 4 hours later at 6,462. 4,400 versus 6,400. That's $1,000 for every Bitcoin. No, 2,000. That's $1,000 for every Bitcoin. Well, if you had $6,000 and you just made $1,000, you're doing okay. But here's the thing. The minute that you think that, you know, the market's going to come down, say we're here. Market's coming down. Oh, look, we've come down more than we previously came down. Can I buy something right here and then know it's going to go up again and give me my profits? Well, no, that's not reality. This is reality. This is what happens more often than not. Is we see a small correction on that pivot only for it to sink away more. You lose all that buying power. And then maybe it comes up to here, and look at where you are. You're no better off. You bought here, you can't sell here. You're making no money. Buying here was not the end of the story. You needed to do more than just buy here. So let's come up with a strategy that allows us to be doing our buying and make money in these opportunities. Let's go back for a little bit here. I'm going to use some made-up math for a minute. I'm going to use some made-up prices just to make this a little bit easier. Let me just draw on here. Just to make the example math a little bit more simple to understand. I'm going to say that this is $100. And that this is $80. Where's my text tool? This is 60. This is 40. And this is 20. We're just using some made-up numbers here to make these points, to make these calculations a little bit easier. Obviously, you'd be using the real price of the market that you're trading. But let's say for a minute that this is where we are. Let's say for a minute that we wanted to, that we're here in the market and we're saying, oh, well, I think it's probably up against, it's been trying to break through this resistance point. Right here, you can see that we're definitely encountering a lot of resistance at the $100 mark. Fake numbers, $100. I'm going to go ahead and buy some. And then potentially the market's going to go down on me. Okay. So let's just say that I buy one Bitcoin and one Bitcoin is worth $100. At this point, what I want you to do is I want you to get out your calculator. Because this is where understanding the fundamentals of what we're doing becomes real important. If you're not practicing this procedure, you're not going to get it. You're not going to understand what we're doing here. Let's say that I bought $100 worth, okay? I now have $100 worth times one Bitcoin. So my Bitcoin cost me $100. Everybody should agree with that because I paid $100 for it. Bought one Bitcoin, paid $100, therefore my Bitcoin is worth $100. In order to be profitable, I really needed to come up here to 120 and sell it out for $20 worth of profit. But if it comes down here, the Bitcoin that I bought will only be worth $80. And I'll have lost $20 worth of opportunity. So how can we make this better for ourselves, knowing that the market could go up, but it could go down? In fact, it's probably likely that it could go down. Knowing that it could go down or it could go up, we need a strategy that has us profitable no matter which way the market goes. So let's say that I bought that Bitcoin for $100, okay? Then the market comes down and now it's at $80. It's at this $80 line right here. With the $80 line, let's say I buy another Bitcoin. At this point, I've spent $100. So what I'm going to do is I'm going to add $80 to what I've spent. At this point, I've spent $180. And I have bought 2 Bitcoin. Which means each Bitcoin is worth $90. One Bitcoin is worth $100, one Bitcoin is worth $80, which means if you average their costs together, they're worth $90 a piece. Okay. So previously, let's put this into the chart. previously, my break-even line, which I'm going to represent here in green, the line that I sort of have to go above is this, this is my break-even line right here at $100, because I got to go above $100 in order to make any money. Anything below $100 and I'm losing money. Well, now let's say that I bought another Bitcoin here at $80. According to the math, $100 plus $80, which is what I've spent, 100 plus 80, which is what I've spent, divided by the number of coins that I have, 2 coins, is $90. So each of my coins is worth $90. That would be the $90 range mark right there. I'm just going to put this in text so you can see it. 90. Halfway between 80 and 100. Okay. Now let's say that the market comes down. We were at $80 and it goes back to 100. Well, if I sell 2 Bitcoins at $100 and each Bitcoin is worth $90, $90 times 2 is $180, but I'm selling them for $100 a piece. Well, $100 times 2 is $200. $200 minus $180 is $20 in profit. You bought at 100, you bought at 80. That makes them worth 90. If you sell them for 100, you're making $10 on every Bitcoin. $10 on every coin. This is called dollar cost averaging. And the idea is that you need to be able to average your cost of your asset as the market moves down. Now let's do this experiment again, except let's use different numbers in terms of how much we're buying. We're going to start by buying 1 Bitcoin at $100. And then when it comes down to $80, we'll buy 2 Bitcoins for a grand total of 3 Bitcoins. Okay, so we need to add $160 because we bought 2 Bitcoins times 80. That's $160. 160 plus 100 is $260. We now have spent $260 buying 3 Bitcoins. If we divide that by 3, each Bitcoin is worth 86.66666667 with a repetition bar over it. So instead of $90 here, we're now profitable at $86. We're profitable when the market goes above this line. Let's do it again. 3 Bitcoins at $80 plus 100 for the original Bitcoin. Now we have a grand total of 4 Bitcoins. Now we're at $85. Profitability line. Comes down a little more. Let's do it again. 5 times $80. $400 plus the original $100 Bitcoin. We now have 5 Bitcoins at $500. Or 6 Bitcoins at $500. 83. Bring it down a little more. Every time you buy more at a lower price, you dollar cost average your profit line lower. Let me say that again. Every time you buy, if you double up your position, if you buy 1 here and 1 here, that would be doubling up your position, you have your profit line. If you then, instead of doubling up your position, if you triple up your position, if you bought 1 here and you buy 2 here, which is tripling up your position, now you have 3 times as much as when you started up here. You have 3 instead of 1. That's 3 times as much. Then your profit line moves to down here. If you buy 4 times as much down here as when you had up here, you quadruple up your position, your profit line's down here. 5x, 6x, 10x. Buy 100 times more. Look at what happens to your profit line. By buying more at a lower price, you are able to bring your profitability to a lower point in the market, when the market can come up even less and make you profitable now. Dollar cost averaging forms the basis for the first strategy. Because what it allows us to do is it allows us to buy any amount here and know that we can buy more here, 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 and here. Okay, so let's say that the market keeps on going down. Let's say we bought one here, double up. Now we have two. Now here's our profit line. Then the market comes down more, all the way down to below 5,000. Now we have, here we had two. If we double up, we buy two. That gives us four. Profit lines here. Now we come down. If we wanted to double up on 4 positions, we would buy 4 more positions. That would give us 8 positions. Profit lines here. Comes down, double up on 8 positions. That's 16 positions. Profit line is here. Every time you double up on your position, you have your profit line. You move your profit line by half of where you moved it to, of where you bought to. Bought from last to where you bought to. If you double up, you move it by half. If you triple up, you move it by 66%. You quadruple up, you move it by 75%. The more you buy, the more you move your profit line down, then the market can come back up and make you profitable. So let's test this out. Okay, let's draw in some support and resistance lines, some pivot lines, where the market is definitely pivoting around. And let's see if we can make ourselves profitable on paper. Because this is the strategy, is to make yourself profitable on paper first. Okay. Here we are, and let's say that, we think that the market's going to go up, and the market's going to go up, and it's going to go up, and oh, it's going to just keep on rising, so we're going to buy around the 5,000 mark. Okay. Immediately, as soon as we buy, you know what happens every time anybody buys for the first time in the market, is the price sinks away from them immediately. Well, if you had bought here and then you needed to double up here, where's your profitability line? It's right here. Green line, profitability. Now, what we're waiting for is we're waiting for the market to go above our profitability line. Did it? Not really. No, it just kept on sinking away from us. Came back down, and then it came down to here. At this point, we needed to double up again. Okay, so if we bring our profitability line halfway down from here to here, that puts us about here. So we bought our first time here, our second time here, we bought our third time here. We're now waiting for the market to go above this green line in order to make us profitable. Oh, hello, profitability. Look at that. We never returned to above this line. We previously thought when we were buying here, we had to go above this. But because we kept dollar cost averaging our position downward, and then we were only buying on the pivot lines, the places where the market pivots and turns around, we made ourselves profitable right here. Look at this. Look at this beautiful motion. Look at how much profit we could have made for ourselves. What is that? That's a 10% profitability right there. Simply by dollar cost averaging a losing position that was starting out looking great, looks like we're buying a bull market. Dollar cost average, now we're profitable. Okay. Now what does the market do? Market comes back down, say we're profitable, market comes back down, hits our support line. What do? Well, we buy, obviously. And the market comes up, gives us profitability. What do? Well, we sell, obviously. If you are not making a plan to buy when the market comes down and sell when the market comes up and makes you profitable, you're always going to look back and say, well, I should have sold when it was high. I should have bought when it was low. I swear, every time that you look at a market and go, oh, it's low, I should buy, and then you don't, it's going to go up, and then you're going to regret it. But every time that you do buy, because you think it's low, the opposite's going to happen. It's going to go down more. Being able to dollar cost average your position means allocating correctly at the top of the market, so that you have enough buying power at the bottom of the market. Because let's say that this isn't what happens. Let's say that the market does one of these. Could have kept going. You needed to make sure that if you started up here and you doubled up here and you doubled up here and here and here and here and here, you better get out your calculator at this point. Let's say you bought 1 Bitcoin here and then you need to buy 2 Bitcoin here. Okay. At this point, you need to buy 2 more Bitcoin here. At this point, you need to buy 4 more Bitcoin here. 8 more Bitcoin here. 16 more Bitcoin here. 32 more Bitcoin here. 64 more Bitcoin here. Does your portfolio allow you to be buying 128 Bitcoin? Because that's a lot of money for most people. That's a lot of money for most people. Now let's take a look at what happens if we start with a smaller position at the top of the market. Instead of starting with 1 Bitcoin, instead what I'm going to do is I'm going to start with 0.001 Bitcoin. It's not a lot of money. It's about, $5 or so. This is, $6, I'm not even sure. If Bitcoin is, I'm just going to make up numbers. If Bitcoin is 6,000, which is somewhere between 7 and 5 today, if Bitcoin is $6,000, then this is $6,000, this is $600, this is $60, and this is $6. 6,666. This is $6 worth of Bitcoin right here. Let's say that I started with 0.001 Bitcoin, $6 worth of Bitcoin. Doubling up here, 3, 4, 5, 6, 7 times. 1, 2, 3, 4, 5, 6, 7 times. Look at how the number changed. Previously, when you were working with 1 Bitcoin and you had to be doubling up your position, you ended up at the bottom of the market with 128 Bitcoin. It's a lot of money, if you ask me. However, if you started out with 0.001 Bitcoin, you could have made it all the way down to here and only have allocated 0.128 Bitcoin. Now, maybe this is too small for your portfolio. Maybe you've got a bigger portfolio and you want to be spending more money than this. Well, you could change the one position that you started with here of 0.0001, okay? But let's see what happens if we do it a little bit differently. Instead of doubling up or tripling up, let's quadruple up. Remember that when we quadruple up, if we double up, we just move our profitability line by half. But if we triple up, we move it by 66%. And if we quadruple up, we move it by 75%. And keeps on getting better and better the more we spend. Spending more at the top just means we got to spend more down here. But tripling up and quadrupling up as we move down means we make our profitability line sooner in the market. So buying more going down should always be preferred to buying more at the top. Let's see why. 1, 2, 3, 4, 5, 6, 7. Just by quadrupling up instead of doubling up, we went from 0.1 Bitcoin at the bottom of the market to 16 Bitcoin at the bottom of the market. What's your portfolio equipped for? The point of today's lesson is to get you to go and find out. Go onto TradingView, pick a chart. Find the support and the resistance lines where the market pivots around. Draw them in. Come up to a point that you think you might have bought the market because you think the market is going up, and buy yourself 0.001 Bitcoin worth on paper. Write it down. Write down on, 1st of, what is this? September, 1st of September, I would have bought 0.001 Bitcoin at $5,000. Then on the 4th, I would have bought, 0.0003 more Bitcoin at 4,400. Then dollar cost average and figure out where your profitability line is. If you doubled up, your profitability line is here. If you tripled up, your profitability line is here. If you quadrupled up, your profitability line is down here. Would you have been profitable? Maybe not right away. So then the market comes down, and then you have to buy more at $4,000. Okay. Then you have 0.16 Bitcoin, and how much do you end up getting to sell? Where's your profitability line? Do the math. Find out. Find out for yourself if using this strategy you would have made yourself profitable, or you would have spent too much at the bottom before you got anywhere near the bottom of the market and messed up. Find out on paper how quickly this strategy can mess you up when the market continues to go down against you. Okay? Do what I'm doing here. Make a plan. Write it down on paper, say this is what I'm going to do, I think the market's going to go up, and then find out that you are wrong by dragging the chart forward. And then have to deal with it. Because that's reality. Practicing trading means dealing with reality, and reality means that the markets go away from you all the time. So get out your piece of paper and your pencil and start writing down your trades and seeing if they made you profitable. Or seeing if you spent too much money here and then the market went away from you here. If you spent too much money here, go back and modify your plan. Because it's your plan that will make you profitable on paper. Once you have a plan that will make you profitable on paper, that's the plan you want to trade. Because if you fundamentally understand exactly what's going to happen when the market continues to go down and down and down and down and down and down and down away from you, if you have a plan that keeps you alive, if you have a plan that keeps you buying while the market is going down and down and down and down and down, eventually, assuming that we're working in a realistic market, the market will go up. Now look at this up compared to this down. Do you have a plan that will make you profitable? Starting your buy here, buying all the way down to here, and then having the market do this. Will this make you profitable? If this plan won't make you profitable, don't trade that plan. Plan the trade and trade the plan. And that is the way of the trader. Next up, we're going to have our very own Casey Watkins show you examples of how he has actually scheduled pivots in these markets against historical resistance and support lines, and how he has scheduled his dollar cost averaging to show him that he really can survive this market going all the way down to here. And then how he made himself profitable by following that plan and then selling when the market did this. This is what you plan for. This is why you're making money. And that's the way of the trader. I really invite you to be making your plans and showing them in the dojo. If you want to share a chart that you draw, if you want to share your support and resistance lines, what you can do is you can come down here and you can click on this screenshot right here. You can copy this link and paste it into the dojo where we all can see it. Go draw your support and resistance lines. Go find your markets that you like and see where they pivot on. Go make your plans to dollar cost average as the market comes down. Go see how you could have made yourself profitable on paper using a strategy like this one. Also, go and find out how this strategy could have really wiped you out if you used it with too much money or if you used it incorrectly. Do so on paper. Because on Wednesday, we're going to show you more about how to maximize these types of opportunities while not destroying yourself, while not wrecking yourself. But I promise you, if you try and go out and trade this without planning this out, you will wreck your portfolio. If you try and dollar cost average a market that's just going to go down and down and down, it's never going to come back up, you will wreck your portfolio. Don't do it. Learn how to be maximally profitable, but learn how to do it on paper. Make yourself profitable for the next 3 weeks on paper before you go and spend money finding out that you were wrong and you didn't plan correctly. You got 3 weeks of dojo. Spend them planning your trade and trading your plan on paper to make yourself profitable on paper. So the minute that you know everything that you need to know, you can hit the ground running and you've already got the plans to go. You've already got the plans lined up and you're ready to trade them. Why? Because you spent the past 3 weeks making those plans and watching them make you profitable. And that is the way of the trader. Thank you very much, everyone. I look forward to seeing what Casey comes up with because he is a real master of this stuff.